Canadian banks will be to blame if a U.S.-style financial crisis is caused by the Canadian housing downturn. The long-term financial difficulties of extending mortgage amortizations. Implications for banks, home borrowers, and national economies. Introduction. Extending mortgage amortization periods can be perceived as a strategy to keep home borrowers' payments low in the short term. However, it is crucial to understand the potential long-term financial difficulties that can arise for banks, home borrowers, and national economies. In what follows, we'll explore the implications of extended mortgage amortizations, highlighting the risks and challenges that emerge over time. By examining the impacts on financial institutions, borrowers, and broader economies, we can better understand the potential consequences of such practices. Impact on banks. Extending mortgage amortizations poses risks for financial institutions, including banks. Increased credit risk. Longer amortization periods expose banks to higher credit risks, as the extended repayment duration amplifies the probability of borrower defaults. This can strain banks' balance sheets and erode their financial stability. Interest rate risk. Banks rely on short-term borrowing to finance mortgage loans. Extending amortization periods may expose banks to fluctuations in interest rates, as long-term loans can lock in lower interest rates that may become less favorable in the future. This can impact banks' profitability and liquidity. Liquidity risk. Extended amortization periods tie up banks' capital for more extended periods, reducing their liquidity and ability to respond to changing market conditions. This may limit their capacity to lend for other purposes, hampering economic growth. 2. Impact on home borrowers. While extended amortizations offer short-term payment relief, they can lead to long-term financial difficulties for home borrowers. Increased interest payments. Longer amortization periods result in higher total interest payments over the life of the loan. Home borrowers may end up paying significantly more for their homes, affecting their overall financial well-being. Extended debt burden. Prolonged amortization periods keep borrowers in debt for longer, hindering their ability to build equity and accumulate wealth. This can limit their financial flexibility and create challenges when planning for other financial goals, such as retirement or education. Vulnerability to economic shocks. Home borrowers with extended amortizations may be more susceptible to economic downturns, job losses, or rising interest rates. Such events can strain their ability to meet mortgage payments and increase the risk of default and foreclosure. 3. Impact on national economies. Extending mortgage amortizations can have broader implications for national economies. Wealth inequality. Extended amortization periods can exacerbate wealth inequalities, as homebuyers accumulate less equity over time, limiting their ability to build wealth through homeownership. This can contribute to a growing wealth gap within societies. Reduced consumer spending. Higher interest payments resulting from extended amortizations can reduce disposable income, impacting consumer spending. This can have a ripple effect on the economy, potentially leading to decreased economic growth and slower recovery from economic downturns. Systemic risks. If a significant portion of the mortgage market consists of extended amortization loans, the overall financial system may become more vulnerable. Widespread defaults and foreclosures could destabilize banks, create a decline in housing prices, and potentially trigger a broader economic crisis. Conclusion. Extending mortgage amortizations to maintain lower payments for home borrowers in the short term can create significant financial difficulties in the long run. The risks faced by banks, the increased burden on home borrowers, and the potential negative impact on national economies highlight the need for a balanced approach to housing finance. Policymakers and industry stakeholders must carefully consider the long-term implications of extended amortization periods and implement appropriate measures to mitigate risks, promote financial stability, and ensure sustainable homeownership for individuals and families. A comprehensive approach that includes prudent lending practices, robust regulation, and supportive housing policies is crucial to achieving a healthy and resilient housing market for the long term. A question that should be asked: Have there been instances where governments have implemented measures to extend mortgages in response to financial crises related to the housing market? Besides the UK recently in June of 2023. One notable example is the financial crisis in Ireland, commonly referred to as the Irish property bubble, which burst in the late 2000s. During the crisis, the Irish government implemented several initiatives to support struggling homeowners and prevent mass foreclosures. One of the measures involved the introduction of the Mortgage Interest Relief (MIR) scheme, which aimed to provide relief to borrowers facing financial difficulties. The MIR scheme allowed eligible homeowners to extend their mortgage terms, resulting in lower monthly repayments. The unintended consequences of these measures were significant and had long-lasting effects on various stakeholders. Banks and financial institutions. Extending mortgages placed a considerable strain on banks and financial institutions in Ireland. It resulted in increased credit risk for lenders as the prolonged repayment period heightened the possibility of defaults. This led to a significant rise in non-performing loans and impaired the financial health of many Irish banks. Some institutions required government bailouts or underwent restructuring to mitigate the adverse impacts. Home borrowers. While the extension of mortgages provided immediate relief to struggling homeowners, it came at the cost of higher overall interest payments over the extended term. Homeowners faced increased long-term debt burdens and continued to accumulate interest, which impacted their financial stability and wealth accumulation. Furthermore, despite the measures, many borrowers still faced foreclosure due to the severity of the crisis. Economy and housing market. The extended mortgage measures had broader economic consequences. The bursting of the property bubble led to a decline in housing prices and a rise in negative equity, where the value of homes fell below the outstanding mortgage balances. This affected consumer confidence, reduced household wealth, and led to a contraction in consumer spending. The overall economic downturn, combined with the troubled banking sector, resulted in a deep recession in Ireland. The Irish experience serves as an example of the challenges that can arise when governments opt to extend mortgages to mitigate mass foreclosures. While these measures may provide temporary relief to struggling homeowners, they can have significant long-term consequences for banks, borrowers, and the broader economy. The Irish case highlights the importance of carefully balancing short-term interventions with long-term solutions to address the root causes of the housing crisis. A comprehensive approach that considers systemic risks, financial stability, and sustainable homeownership is necessary to ensure the desired outcomes without exacerbating the underlying issues or creating unintended negative consequences. If you found this video and information useful, please smash the subscribe button and hit the notification bell so we can keep providing you with timely information you can apply on a daily basis.